Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Copart and do a stock analysis on them. But before we get into that, make sure to subscribe to my channel, Balance Sheets Matter, because if you like individual stocks, I do stock analysis on individual stocks, giving you potential good ideas on stocks to buy and value traps to avoid. And how I do this is I dive into the financials, see where the current status of the company sits, what's improving, what's getting worse, and from that, basically try to determine what a valuation for the stock could be, what a potential buy price may be, or if there's something fundamentally wrong, and it could be a big value trap. So, Copart, this is a stock that has been a very high quality stock basically in the past, and we're going to find out if that's going forward because over the recent year and a bit, they have fallen over 48%. And in the recent history, you can see this is one of the larger falls basically that has happened in 10 years plus for the stock. So for those of you basically who don't know what Copart does or want a little bit of an explanation, we can just go down to the company description here. And effectively, they have salvage auctions for vehicles that primarily are from insurance companies. If you want, you can pause the video, read the full description here. But this basically accounts for 80% of their business, which I just described. And the first question to ask is like, well, why are they down basically 80%? Well, I have the little AI overview here, which is largely kind of a summary of what's going on and kind of a lot of what the analysts basically opinions are on it. And you can see right now, one of the big things is basically the global insurance units, where they get 80% of the inventory, fell by 9.3%. And with this basically dropping inventory they're getting, well, they don't have as many cars to sell anymore. And you have to realize this is something basically completely out of their control. This is just whatever the market is going to give, they're going to basically, that's all they have to, to deal with there. And, reduce total loss frequency. While the long-term trend saw a rise in total losses, there has been temporary non-catastrophic decline. So what's happened in basically past years, as it actually explains it too, there was in the previous comps they had, there was a lot of catastrophic basically events from hurricanes and flooding, which caused basically a lot of cars that they got inventory and were salvaged. So I actually look at this as potentially kind of a good thing because this isn't going to be a systemic long-term issue. Just because you had good comps from a year ago, and that's not the case for this year, that may be presenting a buying opportunity and a good value for the stock going forward. They're also saying that, well, rising insurance premiums have led some consumers basically opt out of getting the full insurance, which basically means there's less cars that are flowing through insurance channels in the Copart's auctions. And you can also see that, well, the revenue basically slow down, and this is kind of coming from the analysts here, are basically saying, oh, there's falling gross profits and partially due to rising operating costs. So we're going to be examining that if that is actually basically true. There's also been a few earning misses over time. So you can see they're saying, the rising operating expenses, the market share of the competition. There's, basically a little shift in the type of cars that basically Copart is handling, and other things like a DOJ investigation, which I don't think is really a big deal, restating these macro headwinds, and the technological shift. Although I don't think this technological shift something was just realized by the market in the last year. And one also thing to realize is there isn't, even if there is more of a technological shift, these are electric cars, and actually electric cars, when they do have accidents, they do get basically salvaged more often because small little accidents, can cause damage to the battery or other parts of it, causing, basically actually a higher salvage rate than you would from an accident of a normal gas-powered automobile. So with that little bit of preamble, let's now dive into the financials. And I'm going to give you basically my opinion from what the financials are saying, basically challenge and see if some of these ideas are accurate, to see if it is, a good value or not. So the one thing we can see is the revenue historically over the last 10 years has grown at 16.4%. And our revenue trend line here, which is 13.7, that's probably a little bit more accurate, is the blue line here. And the revenue estimates by analysts going forward basically are a little bit on the lower side. And I calculate these up before, and they're ballpark around 10%. So the analysts, as we could tell by the sentiment of the headwinds, basically are expecting a little lower growth going forward. And in the past, EPS growth, was very aggressive too. And analysts are also expecting this to change a little bit in the future. So we go basically down to the revenue, and the one thing you basically will notice is, well, we haven't had a whole new complete year right now. The current year to date is effectively actually has a little bit lower revenue than the year ending in July 2025. And you can see this, for example, in the last quarter ending in January 2026, there actually was a very small drop in revenue, which is those overall economic factors basically that Copart is encountering, with basically less cars being delivered to them by the insurance companies because of the high comps from the previous year. But now we do look at the gross margins, which they were talking about, and it's something I always look at in my videos, which is very important because this is something analysts focus on, and this is something that really can determine the direction of the company. And we do see, for example, the gross margins here are sitting just a little bit over 45%. And while this is marginally down from July 2021, this is kind of a one-off year. In the historical trend, looking at the last 15 years, this is actually a rising and stabilizing trend for gross margins. So I do not see that Copart is actually losing any competitive edge or their moat right now due to competition, because they really aren't having to drop their gross margins. Typically what happens when there's more competition, a company loses their competitive moat, well, they're going to have to drop their gross margins to stay competitive. So what we're basically hearing of the headwinds, I'm seeing the financials is not exactly the case. The next thing to look at basically is the operating margins. And these right now are sitting at 36.49%. And we were hearing again, their overall operating costs were rising, which were putting pressures. And well, it does look a little bit true in the short term. This is kind of only from this one point of July 2021, where there did seem to just be an abnormally high comps. And from that, it's kind of trended down to 39, 38, 37, 36 and a half. But is this really a long-term trend that's happening? Because if we look pre-2021 and 2020, we actually have 35% and below. So while this is a very short-term correction into operating margins, this does not actually look like there is a systemic trend happening in it. So right now, the analysts kind of are forecasting this is going to go lower, but from my overview here, I am not seeing that this is actually potentially a trend that will continue forward. And maybe this is just stabilizing at these levels and may actually continue to rise up a little bit again. The nice thing about Copart here, which now we look at basically their interest, expense, and income, is their net interest income is sitting at almost $2 million, $200 million. Because this company is an extremely strong financially, well financialized, company. They have no long-term debt. They have a lot of cash sitting on their balance sheet, earning basically interest, which we're going to go over what they're going to be doing with it. And that does put them in a very strong, basically, position. You effectively have no risk of bankruptcy, or less, when you don't have any interest rate and you still have strong margins and profits like they currently do. And this basically leads down to bottom line net income of just over $1.5 billion. And we can see that their net margin is sitting at 33.76. And this is a little bit higher than the previous years because of this interest income. So if this interest income basically goes away because they spend the money, well, you can expect basically the net margin to go down a little bit. But if you kind of look at the history, this has been an expanding net margin over time, although it is starting to stabilize in the last basically 5 years. So it is very possible that Copart is entering the stabilization phase of their margins. The next thing we look at the shares outstanding. You can see that Copart actually has minorly increased their shares over the last previous years, although in the longer trend, they actually were buying them back. And with their strong balance sheet and the cash I'm going to show you, this does get into basically what management is starting to plan to do, which may provide some upside for the stock. Because we go through their balance sheet here, you basically see they're sitting over $5 billion in cash. So this is what's earning the interest right now. And that leaves them basically total current assets of almost $6.2 billion. And what's really crazy about that is the total current liabilities is only $614 million. So this is one of the best current ratios basically I've seen out of a lot of companies, because they're just sitting on mountains of cash, excess inventory, have virtually no current liabilities. And then we also see their total current assets, which basically is primarily this gross property, plant, and equipment, which I'll go and elaborate a little bit more shortly. They're sitting at over $10 billion there, and total liabilities, their long-term liabilities, are just a very small amount of lease obligations, leaving $788 million in total liabilities. So this leaves actual pretty real tangible equity of $9.8 billion. But I think there's parts that people are missing out of this, and it could be a little bit better. But let's just first put this in some context, because they have $9.8 billion of total equity here. and the market cap is $32 billion. So you kind of have to, if you're looking at that, they have, say, $10 billion of equity, you can kind of say that, well, the cash and their assets, that's $10 billion of the business, and then the actual cash flow part, we're valuing at 20. But I actually do think it's a little better than that. So one of the reasons is basically the majority of the assets they have is land. They actually own 90% of their land. So when we're seeing that they have that $3.7 billion in property, plant, and equipment, this is land which actually could be worth quite a bit more. And we can see from this basically little eye summary, trying to get a guesstimation basically of the value of the land. They're saying, 90% of their, 16,000 acre footprint, 14,400 acre zone. And here's like, different estimates you could do. And the summary is that a lot of these yards are actually located near major metropolitan areas, and it has zoning for outdoor storage, which is very hard to get going forward in the future. So this value could actually put them at the upper end. So you could actually consider the land they have is not worth 3.7 billion, but could potentially be worth between 10 and 14 billion dollars. So that may actually mean there's an extra $10 billion there kind of sitting in the company's value on the balance sheet that we are not basically seeing. So when you actually start applying that into the market cap and look at, hey, this company, actual real tangible total equity, because the land actually is also going, more up in value over time. They have a $32 billion market cap, maybe $20 billion of actual real equity in the company, meaning the actual business is only being valued at a market cap of $12 billion. And now, what are they basically going to be doing with this cash? Because you can look at a few of these things I like to normally look at. Cash flow from depreciation, the purchase of plant, property, equipment basically is marginally higher. And this is typically normal for an expanding company. Sometimes companies who aren't growing, if they're spending more basically purchase of plant, property, and equipment, this can mean that their balance sheet basically assets are overstated. But I think in the case of Copart, what they're actually doing is they're actually buying useful land that's going up in value. So if anything, we kind of already went over, it's a little bit understated. So, purchase of businesses, very, very minimal, not a large part of their business. The purchase of investments here, this is just, they're probably buying treasuries, and that's where they're earning their interest from. And the interesting thing you will see is they have not purchased any stock recently in the recent, basically at least since, 2020. And that's not necessarily like a bad thing since 2020. And if we just, jump into my little chart here, the stock price actually has been relatively high, and that's where the stock has been more expensive. And a lot of companies, which, Copart actually doesn't do here, is they end up buying back all their stock at high prices. And this is one thing I like about Copart is they haven't done. They're basically set on that cash. They haven't spent it at high prices. And, this gets into, what they're basically planning on doing with the cash on their balance sheet. And for the first time in a long time, they've actually started a share repurchase program for at least, $500 million of stock here, which they haven't done repurchases in a very long time. So Copart basically, at least management, recognizes that the stock actually may be a little bit on the cheaper side. And this is a good time for them to basically, start investing in share buybacks, which is really nice because, they haven't done it when the stock is high. Sentiment is low right now from the analysts, and they're therefore able to buy those shares back at a more attractive price. And then other than that, it's just, general improvements to their business and, buying more land as they always do, and basically just having a strong balance sheet that they will be able to ride out any, hard economic headwinds that may happen in the future. So overall, I do think, Copart is sitting in a very strong financial position. They have a lot of assets. You can see their free cash flow is also very, very good. So now let's go basically interactive chart here and start getting some ideas of where the valuation may be at. One thing I always like to bring up is basically, get an idea of the revenue with estimate. This is done by the analysts, and the EPS estimate without NRI. And the one thing you will notice is that the analyst estimates basically for the revenue growth are not at the highest rate. You could say for these years it's actually under 10%. And if you look at the EPS estimates, they're actually even lower. And this is largely because of all these perceived basically headwinds, which I think from the financials when I was looking at them before, does kind of show a lot of these may be a little overstated. So you have to see right now that the stock kind of is being priced, and at least what analysts are looking at, is going to be not very high expectations, because what are they expecting here? The year ending July 2026, 1.58, earnings per share there, then 1.68. That's only a 10-cent increase. That's very, very, low. That's below 10%. Then, 1.6 to 1.81 to 1.9 to like only 2.2. So what analysts are expecting is they're expecting, these persistent problems for Copart basically going forward, which from my analysis may only be temporary, basically economic headwinds, because I don't see any fundamental deterioration in the business. That's just one important thing to do. The next thing we're going to do is look at the price to earnings ratio, because typically a lot of the times for companies that actually do make consistent money like Copart is that you'll find the stock has a high PE when it's basically more expensive, and it has a low PE when it's more attractive to buy. And if you do look at basically the stock chart here, you actually do kind of find this pattern occurring. For example, at the bottom of 2022 here, the PE was getting down to the low 20s. That was the time to buy it. When it does get more expensive, the stock basically, was pushing over 40. And right now we are at a 21. Although this isn't the lowest type of price to earnings basically that Copart has had. They have had periods such as 2017 where they got into the high teens, maybe even 15, 16 at the very bottom here. 2008, 2009, they actually went below a 15 PE. And, in 2003, they also basically went down to as low as a 12 price to earnings ratio. So this does kind of show from at least a price to earnings ratio that there could be potential more downside for Copart if, effectively the analyst and institutional interest basically isn't there. But I think basically in the longer term, that would present, just effectively better buying opportunities potentially. Next thing to look at is the price to sales ratio, because price to sales ratio is basically a derivative of the price to earnings ratio, but you do have to relate it to the net margins, which we're going to bring up shortly. And you can see that the price to sales ratio did get very high, pushing actually at a lot of these times here close to 14. And we are basically at a 7.5 right now. So you have to determine, is this basically 7.5 realistic, since this is basically, higher than all the times from 2017 and before. And basically 2017 and before, you had more basically extremes of about, what's this, like say 2.8 at the bottom. Actually, let's say, 2 at the very, very low. And, it kind of got up to 6 to 7 at the highs. But the reason for that is if we bring up the margins here, let's bring up the net margin and the operating margin. I think both of those are the more important ones to look at. So maybe just look at one of them at the same time to get a little bit clearer trend of basically what's going on. So basically, it was kind of before this time here when the operating margin was on average a lot lower. And we go, pre-2000, it was really low. It was moderate around here. So, but the overall trend is up. And this is what I was saying earlier of that, well, there is a little pullback in the operating margin currently, that has happened before when there was economically bad times, like the 2008, 2009 recession. But you also kind of have to realize that these things don't necessarily pass overnight. They peaked their operating margins before at 2007, and they actually didn't bottom until 2014. So that was a 7-year period of contracting operating margins. And as we know, the price to sales ratio was priced a lot lower. Although I think they probably didn't have as much basically equity on their balance sheet. They certainly didn't have as much cash, and the property value, probably wasn't as high as well. And right now we've had, the net margins basically peak in 2021, and it's been 1, 2, 3, 4 years. So it has been quite a few years, but it wouldn't be completely out of the ordinary to see a few more years of contraction. But even if it was to flatten or contract a little bit, this still would be within a larger basically uptrend. And I think that would just be more of an economic condition and not overall collapsing of fundamentals. But this would potentially, at least in the short term, garner a lower valuation. Now let's basically look at the net margin here. And we're seeing generally the same thing, although we probably wouldn't see the net margin, even if it came down a little bit, get close to these previous levels. And this is largely because the tax cuts that happened. I think they were in 2015, 2016, when Trump was basically first elected. There was corporate tax cuts, and that did effectively help boost the net margins up. And one thing you got to realize, well, for basically every company out there, if corporate tax rates were to rise in the future, that would negatively affect all of the company's basically earnings. So I think from a price to sales ratio perspective, you would probably expect it to be higher than the previous times in 2017. Because from about here, it was about a 19. We can just round that to a 20. And if we were to get a little bit of contraction, we might end up around the 30. Okay, so that would basically, let's take this out, lead us to a fair price to sales for previous comps in this area when the stock was actually very suppressed. And when we do want to fund a stock on a value, we want to buy it effectively at a suppressed level. So we would be looking at values potentially 50% higher than this. If we look on the low side, let's just call it 3, not the this exact low here, which was a little bit lower, but it's like say 3, and on the higher side it was getting to what about 5 there. So if the margins were to compress a little bit, that would put this, at least from this perspective, a fair price to sales ratio of about 4.5 to 7.5. And you do have to factor in a little bit that we're not fully factoring in all the land value at that point, but the analysts may not be doing that either. So because of that, just realize that if sentiment gets worse for Copart, the margins do contract a little bit. You actually could see some more downside here from what we're seeing. So what does basically that look like on the chart here? So this is why I basically have these two different levels here. Right now at the one level, which I do actually think is a relatively attractive price at $33, but I would not be surprised seeing the stock trade down to $25 for those reasons. If there is some more economic headwinds and the sentiment for the stock, the analysts don't like it, it would not be surprising to see it get this low. Personally, myself, I've started a little position, and the thing is, I say this for a lot of stocks because I actually do own a lot of stocks, and that's kind of my methodology. Is when I see it get kind of what could be a good value, I do start buying a little bit, but I don't fully build up the position because I do realize that if you do get some more headwinds, which we do see as a possibility with basically Copart going forward, they could get a lot lower. But at the same time, the reason why I started a position is this is a possible area of basically support. You can see from the consolidation in 2022, that seems basically like a good level, there from a technical perspective, from a price perspective, they can be pretty attractive. And also, if we look at kind of the trends here, this 100-month moving average has acted as support in basically both the 2000 crash and the 2008-2009 crash. So, that kind of does give you some food for thought that, Copart could be a good value here. I've got my starter position for it, but I could see it easily trade down to 25 or even a touch lower. Anything's basically possible. But I think, longer term for Copart, even with lower revenue estimates, I think the company is basically sitting in a very good place because we do see there's a lot of value on the balance sheet, and the company really actually is only kind of considered 1/3 of that market value. So if we go back to what the price to earnings ratio is here, which we can see on the front of the group focus page of 21, you could actually kind of perceive this as chopping this in a 1/3, take out basically the equity value. And that would kind of say that, hey, Copart right now is potentially trading at a 7 PE, or at least that's what the business is trading at. And businesses get cheaper? Yeah, a lot of actually stocks, do get cheaper than that. And we are factoring in land value, which actually isn't reflected on their statement. But from a very long-term perspective, I don't really see any possibility of, Copart basically going bankrupt. They have that underlying land value. And when we kind of value the business at even this slow growth scenario, and you got to remember with the land they have, they can't pivot their business and change it. From the longer term perspective, I would likely see them basically resuming this trend, especially considering they do have that $5 billion on the balance sheet, and they may be allocating a few $1 billion of that to basically some share buybacks. So anyways, is Copart, in summary, basically a good value now? Well, I think it potentially could. I also do think it could potentially go a little bit lower, which I do say a little bit of stocks. So anyways, this isn't financial advice. You got to make your own decisions if this is the right investment for you. But I think over the long term, years in the future, 5 years plus, we will definitely see Copart resume this longer term trend and potentially put on some significant gains. And you do have to consider that if what the analysts are basically expecting for all these headwinds don't materialize and the growth does reaccelerate, not even reaccelerate, but just go back to the previous trends, that does actually provide quite a bit of upside for Copart, since they were trading in this upward channel here. And if they were even, just to get back to the middle of it, that could be, 80% additional upside. Along with what I have here is the average trend has been 17.5% per year. So I think there is potential of a lot of upside surprise for Copart with some, improving basically economic conditions, but we don't know when those economic conditions will potentially improve. So anyways, I hope this has given you a few insights into Copart. If you like the stock analysis, make sure to subscribe to the channel, like the video, and I will see you in my next stock analysis.